Hello folks, I've got another update, and it's a news article that isn't directly about gold and silver or precious metals, but I think you will find that events such as this have a significant effect on the prices of and the future of the precious metals market. And again, it is from Market Watch. The title is, it's June 4th article, and the title is, quote, Hungary warning heightens sovereign debt fear. So, Hungary's new government added to sovereign debt fears Friday, shaking global financial markets after a spokesman for Prime Minister Viktor Orban, I'm sorry if I didn't pronounce that right, was quoted as warning that the economy had been left in a, quote, grave situation, end quote, and that all talk of default wasn't an exaggeration. Okay, so these remarks put pressure on the European banks who were exposed to Hungarian debt, and it weighed on European stocks, and also was bad for Wall Street. It says here that the comments by the spokesman Peter Zijarto, and I'm sorry if I didn't get that name right either, follow a warning by the deputy leader of the ruling Fidesz party on Thursday that Hungary was in danger of a Greek-style scenario. Hungary too? Okay, so there's a quotation here. The comments made over the past 24 hours are highly concerning, as they not only increase the fears in the market of a possible Hungarian default, but also clearly demonstrate that the Hungarian government has very little understanding of how the financial markets actually work. Surprise, surprise. This is Lars Christensen, chief analyst at Danske Bank in Copenhagen. The Hungarian forint fell sharply for a second day, dropping 2% versus the single currency to trade at more than 289 per euro, its weakest level in a year. Earlier it had traded at 285.55 per euro, and that was a loss of 1.6%. Anyways, these remarks contributed to a sharp fall by the euro as well versus major rivals, driving the single currency to a 4-year low versus the dollar and an all-time low against the Swiss franc. That might be a currency you want to look at. Anyways, a disappointing U.S. non-farm payrolls figure was seen as the primary driver in the euro fall versus the dollar. Interesting. The spokesman said the economy's plight was the result of the previous government, and I'm guessing he's talking about Hungary, having manipulated figures and lied about the economy. A government lying about figures. No. Anyways, I'm sorry. I digress. On with the article. A committee is set to report on the state of the country's finances over the weekend, which will be followed within 72 hours by a government action plan. Ooh, goody goody, the spokesman said. Sijarto says this, quote, I don't think it's an exaggeration at all to talk about a default. Did he just say the D word? Yes, he did, according to Bloomberg News. The use of that word, default, and the sharp criticism of the previous government for going to the IMF will fuel speculation, Christensen says, as to whether the Hungarian government wants to renege on the country's standby agreement with the IMF and the EU. So what's this agreement here? Well, the Hungarian government took in 2008 an agreement which they received 20 billion, with a B, euro as a rescue package from the IMF, the World Bank, and the EU. These remarks by Hungarian officials have also stoked fears of a debt default or a restructuring to the detriment of European banks. Quotation here by T.J. Marta. These developments are important because the losses of the Hungarian debt will likely be shouldered by the European banks that are already about to be hit with a second wave of write-downs. Chief Market Strategist T.J. Martha at Martha on the Markets in a research note, and also said, quote, "This in turn means that financial intermediation generally and globally will take another hit." What? I thought it was teddy bears, sunshine, and flowers. The recovery was on the way. I'm sorry. Anyways, I'll continue. And they also say here at the end of the article, the cost of insuring the Hungarian government debt jumped in the credit default swaps market, and the CDS spread widened from 314 basis points to 400. So that means that apparently the cost of $400,000 a year to insure $10 million of Hungarian debt against default. And this is a rise of $86,000 from Thursday. Anyways, so we see here we've had the Greek default, or the Greek "we're screwed," and we've also had Spain get its debt rating on sovereign debt downgraded. And now we have Hungary, and this is a quote by some pretty high up officials in the Hungarian government saying, we may very well default on our debts. Government guarantees on a debt. Trustworthy? No. Surprise, surprise. I was just thinking though, the old saying that the debtor is the debtor is the slave to the lender, the borrower is the slave to the lender. You think about it. All these governments getting bailed out by the World Bank and the IMF over and over again. So what does that mean about those governments and the people that live under those governments? What does that turn them into? Never mind. Anyways, I hope this helps, and yeah, you'll see probably some spikes in the gold and silver prices. All right, have a nice day. Thanks for watching.